Hello, everyone, and welcome to yet another episode of Capital and Context. I actually can't remember what number episode this is now. We've obviously done quite a few. Mark isn't with me again this week. He's actually in Portugal at a music event, so I hope he's having fun and look forward to having him back next week. This week, I apologise. I'm going to have to refer to my notes quite a few times, so I won't be looking to the camera a huge amount. Got an awful lot of numbers to quote, so wanted to make sure that was accurate. Obviously, everything that we quote here is for information purposes only. Is not meant to be taken as advice or a call to action. But in terms of a question that comes across to me on occasion is, so for the same pound of future earnings, why would you pay 21 times earnings for one company, for one market versus say 11 in another? And that's quite a big gap. That's nearly double. And that's kind of where we're going to go with today's episode, is to help explain why that is. So what numbers I would look at is what you see quoted quite often is the trailing price to earnings ratio. So that's what you're paying for as a multiple of last year's earnings. But personally, as an investor, I'm not interested in that. I don't care about what you paid for in the past. I want to know what you're paying for coming up. You don't want to be paying for someone else's returns, kind of thing. So that's all quite important. And so we look instead of a forward price to earnings, which is the ones that you don't see quoted quite as often. At the moment, most expensive general market is the US at 20.8, though India is more expensive than that again, for domestic kind of reasons. Japan then comes down to 16.9, Europe at 15.2, UK at 12.3, and emerging markets at 11.4. Now that's quite an interesting one at the moment. I'll come to in a second. So at the moment, you're paying about 70% more for a US company than you are a British company, and America costs about 80% more than the emerging markets for every pound of earnings. And when we start at the top there, so looking very much at the US, as I said, it's the most expensive market in the world. But I think there's a very key thing here, and it's actually cheaper than it was. It's actually at the moment at its cheapest level than it has been sustained at any point post-COVID. And I think that's really, really important, because everyone's been talking about, a year ago, forward earnings was 22 to 23 times. But these earnings have been coming through really well and will continue to, hopefully. And that's meant that as earnings have grown faster than share price, you're actually getting a better yield off of your investments now in US equities than you have done at any point in the last 6 or 7 years. And what's been driving those earnings, as of course we all know, has been the AI capital expenditure cycle. There's been roughly $700 billion of capex alone this year, just in the 5 hyperscalers. It's a huge amount. And then, the consensus is that the earnings are going to grow more than 20% this year. One major fund house is targeting the S&P at 7,800 by the year end. I think the US is actually in quite a healthy place at the moment, and I think that's something that we're concentrating on ourselves. There's been lots of conversations about whether to do the market cap S&P 500 or the equal weight. Now, what that means is that because by market capitalization, you got that being the bigger companies in the world take up a bigger proportion of your holding. You hold all of those tech names hold a really significant proportion in that holding there. Versus if you're worried about AI in terms of whether things are overpriced, you might hold the equal weight. So every company of the 500 in the S&P 500 holds a 0.2% holding, and might be a way to diversify. And the thing is, just as we spoke recently, is that those earnings for the those big tech names have been coming through and really, really strong. Have been keep on getting revised upwards. So that's really positive there. So that's been good. But I think the thing that we need to be aware of is an awful lot of US GDP and company growth is coming from a very narrow story. And that actually, if that story unwinds a bit, as we saw a little bit of June, although that was more supply side fear rather than the demand side, and I think that's very important, we might see a bit of a pullback. But I think at the moment, as I said, it's at its cheapest level of forward earnings now for a good 6 or so years. The then we move across into, actually, I go to jumble up my notes. It was originally in the order of most expensive to cheapest. I'm going to go straight to the cheapest, which is actually with emerging markets, which isn't surprising. It has quite wild swings. Emerging markets has had a great year so far. It's returned around 18% so far this year, and the forward multiple has fallen. Now, that's what I was talking about earlier. If the earnings are growing faster than the price increase, then that's because actually, you end up with this shrinking kind of like ratio that indicates cheapness, and I think it's very much true. In January, it was 13.5 multiple, whereas now it's about 11.4. So we're talking quite a bit of a pullback there. And the thing that we're looking there is that this is showing a really healthy rally, even though it's done really, really well. It's kind of the opposite of a bubble here. When you see a bubble is when you would see those forward earnings not really changing, but the price is still very much going up. This has not been the case here. And the other thing as well, when you look at this through a window of averages through time, over the last quarter century, so let's call it this century, the average has been 11.5 to 2. And post-COVID has been 12 to 12.5. So even though we're in an environment where these earnings are expected to do well and continue to do well, they're quite cheap. And I think that's something quite interesting there. Again, the tech traders start to feed through in emerging markets. South Korea, you have Samsung, Hynix, all those memory producers. But the wider sector has actually been doing really, really well. So I think that's quite important. The one that I am quite wary of is on Europe and the UK. So Europe and UK has had a pretty good 18 months, very good 18 months in fact. It currently sits on 15.2. But the problem with both of these is that they're quite expensive compared to their post-COVID, post-Brexit, etc. averages, and that illustrates an area that perhaps we need to be a little bit more cautious around and be a bit more either pull back on our general sector weighting or choose an active manager that might be a better place for such an environment. So looking a little bit more for a value orientated manager. To be fair, our chosen active is actually put out a note recently saying that he's holding a very high amount of cash in the portfolio at the moment, just because he doesn't see where the value within the market at the moment. And I think that's quite a signal there. If someone's saying their own product right now is quite expensive. So I think that's quite interesting. There's another way also to look at whether the PE ratio, as I was talking about, if it being high is justified, and that is the PEG. So that's the price to earnings growth ratio. So that's regards to how much you expect that ratio to change over the next year. And when we look at Europe, it sits at 2.5 versus 2 for the US. So that's showing that you would be expecting that despite the earnings not doing well in Europe at the moment, after all, you've got Germany industrials not doing great, even though there's quite a lot of fiscal expansion hitting real order books now, which is great, but still the forward earnings aren't quite there yet. You're expecting some kind of fairy dust, that thing in the markets that sometimes is the sentiment in the market, which can quite often move markets. It's expecting quite a lot of more sentiment in Europe than the US, and I'm not sure that's justified. So yes, on the 15.2, it's cheap against America, but not cheap versus its own growth. And I think that's important. It's sitting at that in those upper quartiles of its valuation multiple, and also that growth within the PE multiple is expensive there. So I think we need to be selective there, choose things like banks, fiscal beneficiaries and quality growth, with discount, those kind of things that are quite defensive and resilient when we get a bit of a value pullback. So I think that's where our holding should do quite well there. The UK is actually the cheapest developed market in the world at 12.3 times forward earnings. And this isn't awfully uncommon. It has been for quite a while. We know the obvious a negative case, sluggish growth, fiscal strain, political churn, barely any tech in the index, on account of the fact that we love to sell off any good companies that we produce. And that is it in itself, the story, because where we are at the moment is actually near the cheaper end of its post-Brexit valuation range. So it could be quite a value market. However, I think we need to be quite careful within this, because we've come off the back of the FTSE 100 holds an awful lot of commodity-orientated names. Obviously, we've had the Iran war, and that's generated quite a lot of earnings that may not yet have been revised on the forward basis coming back. But also, at the same time, they've been selling off to a bit of a degree with UK sentiment, and also the end of the Iran wars. There's two prices change, obviously, throughout the day, kind of instantaneously as news comes out. Market analysis from the sell side of the industry takes quite often weeks to flow through, and I think that's what's happening at the moment, is that the future expected earnings haven't been revised down yet off the back of a change in the Iran conflict, but the market pricing has already changed down. So I think that's why it looks cheap at the moment, but not when you look over longer time periods going there. The last one I want to touch on is Japan. So Japan, we've been quite positive on for a number of years. I think that might change now. It's had such a great rally, which has been fantastic. It's now the second most expensive market, mature market in the world, ahead of Europe. Go back a decade ago, you wouldn't expect that. As I spoke before, we've had the big corporate reform story, governance overhaul, exchange leaning on companies trading below the book value, which was a big deal, record buybacks, wage growth, and exit from deflation. We've had a new prime minister, which has signalled quite an expansionary stance. But on the great things of things, it's had an awful lot of growth there. It's really sitting at the top end of its valuation range, going back again to those PEG ratios. It's not looking great. So I think that's an area that we might be pulling back a bit on, possibly from our active holding, because the active holding did really well in our previous environment. It's not working quite so well at the moment. So as I said, Japan's looking expensive across all kind of time periods at the moment. And I think that's perhaps where we need to be a little bit more value orientated for a little while there. So I hope that gives a bit of a feel of how I feel going into the second half of this year. US, in my mind, still looks good. Emerging markets still looks good. Europe looks expensive. Japan looks expensive. UK, jury's out. I think, let's be honest, we're all quite aware of where this is going politically with Andy Burnham, what's the new policy is going to be. I'm not awfully concerned about gilts. I think it's been quite obvious from the things that he's been talking about is that spending will largely be funded through tax rises. Problem is those tax rises aren't good from obviously a wealth and spending perspective of the private person, which is possibly where things like 3250 could be hit. So quite wary on those, and obviously need to keep an eye out on sterling. It could do okay, but the bullish case needs to be strongly put out there. We are keeping an eye on we don't hold any on our equities, any foreign currency hedging at the moment, but we're keeping an eye on it. There's a couple of areas where we might do, just where the story seems quite baked in for everything being very much against hedging, say, dollar at the moment. The market might be leaning a bit too hard. That happens quite often sometimes, is that the whole market buys into a narrative. It's quite easy to make up a little bit of return by having a small amount as a contrarian position. Not a hard position, but a small amount there. It's quite possible. So I think that wraps things up for this week. I didn't want to go on too long because obviously I'm aware that this is in essence a bit of a monologue. And we look forward to seeing Mark next week. Hope you enjoy all the sport over next week. Bye-bye.